The US economy is shifting, and many are wondering how will this affect mortgages. So in this video, I'll break it all down with the latest updates on inflation, the job market, the economy, and the stock market. And most importantly, what it means to you as the home buyers and homeowners. So this isn't an opinion piece. I'll be sharing the latest data so you can make informed decisions about buying, selling, and refinancing a home. So let's get to it. Inflation and mortgage rates. So inflation just came out at 2.8% as of February, and that's down from 3% in January. So that's great. Core inflation, excluding food and energy, is 3.1%, which is slightly lower than January's 3.3%. So more good news. But shelter costs, which is rent and home prices, rose year over year, meaning housing affordability remains a pretty big challenge. So how this affects mortgages. Lower inflation generally leads to lower mortgage rates in the long run. However, shelter inflation still being high means home prices and rent remain pretty expensive. The Federal Reserve is watching inflation closely, which will determine if they cut rates this year. Next, job market and housing demand. 151,000 jobs were added in February, lower than the expected 170,000. The unemployment rate ticked up to 4.1%, and we're projected to reach around 4.3% by the end of 2025. The job growth was strongest in healthcare, financial services, and construction, while retail and hospitality saw the most job losses. So how does this affect mortgages? A weaker job market could lower rates if the Fed sees it as a sign of economic slowdown. More layoffs mean some buyers may pause home purchases due to job uncertainty, and construction job growth suggests new home inventory can increase, which may stabilize home prices. What about the U.S. economy and housing market projections? So the U.S. economy grew 2.3% in Q4 of 2024, staying within the typical 2 to 3% range. However, the Atlanta Fed projects GDP could shrink by 2% in Q1 2025, making the worst contraction since the pandemic. So consumer spending is softening, signaling potential economic concerns. So how this affects mortgages. A slowing economy increases the chance of Federal Reserve cutting interest rates, which could lead to lower mortgage rates later this year. If a recession happens, home prices could stabilize or even decline in some markets, and buyer and investors may find opportunities in slower markets if they are financially prepared, so plan ahead. Stock markets, interest rates, and housing. Stock market volatility is linked to concerns over tariffs, economic uncertainty, and inflation. The Federal Reserve is projected to cut interest rates this year, but the timeline depends on the economic data. Mortgage rates have hovered around 6 to 7%, but a Fed rate cut could bring them down quite a bit further. So how this affects mortgages. Lower mortgage rates could create a surge in home buying demand, especially from those that have been waiting on the sidelines. Investors looking to refinance rental properties might see better cash flow opportunities. And if rates drop significantly, expect a flood of refinance applications and home purchase applications, so being prepared early is key. So what does this mean for you? If you're a home buyer, investor, or homeowner thinking about refinancing or home purchasing, now is the time to start preparing, so plan ahead. Thinking of buying or refinancing? Let's discuss your options. So click the link in my bio to schedule a free consultation and drop your thoughts in the comments. Do you think mortgage rates will drop further this year? Let me know.